thrilled to be hosting today's panel. We've got like 4 really distinguished speakers with us today. Korn is not only the chairman of the Thai Fintech Association, but he's the former finance minister. Vivek has this wealth of experience, Africa, Asia, the Middle East, as well as now based in Hong Kong for the IFC. Norbert has done a lot of great work in Zambia, and Maha has basically built the mobile payment system in Jordan. I just wanted to start off today with preface it with a few remarks. We're talking today about financial inclusion, the policy approach to financial inclusion, and I cover fintech in Hong Kong for the Wall Street Journal. Not far from where I work, in a place called Fortress Hill, which is sort of like a satellite business district to Central in Hong Kong. There's a sort of fading office building on the 9th floor of which there's an e-wallet business which just started about 2 years ago. And every Saturday and every Sunday, there's a long line that comes down from the 9th floor. It snakes down to the 8th floor, it snakes down to the 7th floor, where the mall is, and the shop owners get really kind of upset about this because these are mostly domestic helpers, Indonesians, Filipinos, and they are there to get KYC done because they're applying for these e-wallets. And I didn't know about this, but recently I sat down with the CEO. He told me about this, and he explained to me what the e-wallet was there to do. And it was only then that I realized that a lot of the domestic helpers in the Philippines, in Hong Kong, cannot open bank accounts, cannot open a regular bank account in Hong Kong, which is why they're there, and which is why the e-wallet provider is helping. So these are the sorts of experiences that you guys have all been working on. And for me, as a journalist, it's a really rich mine of very poignant stories. So it's great to sort of have the opportunity to talk to you guys. One aspect of it, of financial inclusion, is that it never comes without a cost, because as these e-wallet providers, as these fintechs step in, the traditional banks will start to look at them and realize that in a lot of senses, once they become successful, these fintechs start to look a lot like banks. They're taking deposits, they're taking money. Pretty soon they'll have a float. They want to figure out how to manage this wealth. They start offering insurance, and then they start to look a whole lot like banks. And the traditional banks say, well, hang on, this is getting a bit troublesome. So as somebody who has sort of sat on both sides of the fence, Korn, you've been finance minister, and now you're chairman of the Fintech Association. So in a sense, you have seen both sides of this equation. What are some of the experiences that you've come across in your many years doing this that you want to share?
Okay, thank you. Hello, ladies and gentlemen. Well, first of all, even in a country that is relatively well developed from the perspective of the financial services, as Thailand is, financial inclusion is still definitely an important priority for policymakers. 5 or 6 years ago, when I was in office, we had a strategy to try to help refinance those Thais who were borrowing from loan sharks. So we didn't have the technology then. We just asked for simple registration. Well, 2 million people signed up with a significant amount of debt, paying between 5% a month up to about 20% rate of interest per month. So those basically are the financially excluded. Now, do they have bank accounts? Yes, they do. Many of them do. Over 80% of the Thai population have bank accounts. So by strict definition, there is a level of financial access. So in a country like ours, it's more about fairness. It's more about access to financial products. And that remains a problem. So about a year or so ago, when fintech was beginning to emerge in the Thai community, we decided to form the Thai Fintech Association. And we came up with mission statements. And the two most important mission statement of ours is, number one, to help expand financial access to Thais. And by financial here, we mean loan products, we mean investment products, we mean insurance products. Not just allowing people to have the basic necessity of a bank account. And the second mission is to reduce the cost of financial transactions. Again, right across the whole spectrum of financial services. So having a bank account is obviously an important first step towards having access. But there's a lot more work to be done subsequent to that. The reality is, in Thailand, in a way, we have slightly different problem to that of our immediate neighboring countries like Vietnam, Myanmar, or even when compared to China. And our problem is as a result of the fact that we have a strong incumbent banking sector. So whereas in China, you find that a lot of people just basically step straight into fintech and bypass traditional banking services altogether. Well, the development of fintech in Thailand is development on the back of what is a successful and robust, although expensive, banking system. So that poses a lot of challenge to the entrepreneurs. But the so-called pain points are there, and I think that's key. If you look at overall household debt, the total amount of household debt in Thailand is equivalent to about 82% of GDP. So if you look at that, you might surmise that, okay, it appears that households have access to ability to borrow. But you look into the finer detail, you find that almost 70% of all of the household debt outstanding belongs to only 10% of the population. So access is not well distributed. And that's where fintech can come in.
Is that because it's mostly mortgages that are taken out by the wealthy?
Well, that's another issue. Most of the debt is consumer credit. In a more developed economy, let's say a high benchmark, nevertheless, in the United States, 40% of households would have mortgages. In Thailand, it's 4%. Okay, so the most basic form of household borrowing, the safest form of household borrowing, and the kind of borrowing that leads to the greatest sense of financial security, i.e., ability to own your own house, is not available to the vast majority of Thais. Only 4% have access. So there's a lot of work to be done as a result. And part of the problem is actually legislation. Even subsequent to the 1997 financial crisis, when bankruptcy laws were somewhat relaxed, it is still very hard for financial institutions to seize houses used as collateral, which means that in Thailand, we're almost unique in that it's actually cheaper to borrow to buy a motorbike than it is to borrow to buy a house. Now, that's very rare. I challenge almost any other country to that. And the reason why it is much more expensive to borrow to buy a house in Thailand is because of the legal due process that is required by banks in the event of the loan going bad. Takes at least 5 years, whereas it takes about 4 months in the example of a motorbike. And that is even given the fact that NPL for mortgages is only about 5%. So effectively, 95% of borrowers who are good borrowers are being penalized by this by this law, which is not allowing market mechanism to work through. So there are lots of different issues: competitive issues, legislative issues, structural issues. That means that financial access, by definition of being open and relatively cheap, is still a big challenge in Thailand.
Yeah, sort of related to that issue, I sat down with Alibaba recently, China's Alibaba, and they said that the cost to an average traditional bank of a consumer loan is about 2,000 RMB, it's about 2,000 yuan. The cost to them is 2 to 3 yuan, so it's like yuan, like it's a thousandth of the cost. So it's sort of related. But Vivek, back in the green room, we were talking about your experience in Myanmar. That was really fascinating, and that's sort of somewhat related to what Korn was talking about. Do you want to share a little bit about that?
Yeah, so first time I went to Myanmar was 1994 or 95. And I used to live in Bangkok in those days, and mobile phones were very popular in Bangkok, and went to Myanmar, and forget mobile phones, you couldn't even use a landline. It didn't exist, or they weren't working. Went back there in 2014, 20 years later, and I had my US cell. Roaming wasn't working. My office gave me a local SIM card. Very spotty, very hard to make calls. You go to Myanmar today, penetration is north of 80%, and about 70 to 80% of that is actually smartphones. And the reason that's important is because that's the way I think Myanmar is going to be able to leapfrog and really catch up and have financial inclusion take place here. I don't think physically or financially the days when you need to have a bank branch in every village, those days are long gone. And I think I'm not carrying my mobile phone, I don't know where I've left it, but your bank account or your bank branch is your mobile phone today. And I think that's what we're seeing in countries like Myanmar, which have taken some time to join the rest of the world. That's how they're going to catch up with the rest of the world when it comes to areas like financial inclusion or retail, things like that.
Okay, and Vivek, you've done a lot of work, as I said earlier, Africa, in Asia, in the Middle East, and now you're regional director of Asia Pacific for IFC. But one of the roles that you had in the past as well was in Washington, D.C., where you worked on, among other things, figuring out how to give the unbanked and the underbanked a credit access. And one important aspect of that is giving them some sort of credit scoring. Can you talk a little bit about how you worked on that?
Yeah, so I think it's really one of the big challenges that financial institutions or development finance banks like ourselves face, is how do we sort of determine the credit worthiness of people who probably don't even have a bank account. Now, it's very simple. You've got credit rating agencies. It's very easy to rate companies, firms, certain individuals who've got a credit history. So the interesting thing is and I think big data changed the game completely. Because big data, so you look at it 20 years ago, if I wanted a loan in the US, there's a credit rating agency, I'd get a credit score, and based on that, that would determine the amount of the loan I got, the interest rate that I paid, sort of the traditional way of determining who gets how much when it comes to getting debt. Today, there are credit rating companies that effectively either get into your phone and figure out your behavioral patterns. There are credit rating companies that actually observe your behavior on which social networking websites you are, and you're actually getting credit based on behavior, and to some extent, I'm sure they're tracking your past track record, but it's a completely different and innovative way of looking at it, and it's much faster. I'm told Alibaba and Financial, they can, if you're a regular client of theirs, they can determine what Jack Ma says 310. In 3 minutes, you will get a credit score which will determine how much money you'll get. So it's a completely new paradigm, and that's what I think is really going to spur the whole area of financial inclusion in a very big way. It's going to be sort of a dramatic shift on how people who were not able to access credit in the old days because they didn't have a proper credit history, they didn't have bank accounts. Today, based on your social networking sites, behavioral patterns, these people are going to be able to access credit. It does come with a lot of challenges, I think. So I think 2 challenges that at least concern some of us. One is there going to be a lot of debt being taken on by people? Because you need to have, so clearly the tech fin industry or the fintech industry is moving very rapidly. I mean, there's a lot of innovation, a lot of very interesting things happening. But I don't think the rest of the financial system is moving as fast. Yeah. So how do you control the amount of debt and the whole issue of indebtedness at an individual level or a household level? How do you at least track that? I'm not saying it should be controlled, but you need to have a system of tracking that. So that's a big concern, I think. You know, microfinance, if everybody can borrow money based on social networking sites or whatever, great. But who is tracking how much each individual borrower is borrowing? That's one thing. The second is the whole area around data privacy. I don't think, I am very concerned myself personally about data privacy, but you have companies today doing very well that basically you give them access to your cell phone. So they know everything you're doing, every call you make, who you're talking to probably, which restaurants you're going to, which websites you're visiting, how do you shop, and you know, probably even where you're going, because your cell phone will tell you where you are. So I think these are some of the concerns that we need to be mindful of as we continue to innovate.
Let's turn to Maha, because she's done a lot of work in Jordan, and it might be helpful to sort of drill down, particularly when it comes to some of the issues that Vivek had raised, you know, in terms of level of indebtedness, privacy, because Maha, basically she designed Jordan's mobile banking, mobile payments system. Do you want to share a little, and also about credit history?
We have now, as you know, the mobile switch. It's a centralized national switch. So since it is centralized, we can have all data about mobile wallets, and we have a credit bureau for bank accounts, and we have now a design that will utilize big data and machine learning, artificial intelligence to collect the data and to build credit history of mobile wallet holders. So even people who never had any access to banks or without any credit history from banks, we can work on having, let's say I prefer another term, intelligent scoring. So having intelligent scoring will provide them access to credit, and adding to that precise credit risk premium. It's not always about having access to credit. It's even more than that. I need fair pricing of credit risk. As for all related items of indebtedness, again, when you have like centralized platform where you can collect data utilizing unique identifier number about, for example, Maha, you can get a macro level picture about the overall debt I have. So you can at least prevent me from going into the trap of over-indebtedness or exposing myself to other risks. So it's like this is within the design of the platforms. Adding to that, you need always to keep on designing your regulations to fit what is currently in the market. So if we want, as a regulator, to comply with the innovations, to apply new technology, we have to keep on learning what's going on in the market. So there's no one size fits all. And I always, as well, believe that the regulators should not rush into regulations. You have to wait and see somehow. It doesn't mean that we forget these areas. No, it's a dialogue methodology. We need to learn from these innovators, because if we put regulations early or at early stages, we will end up whether impeding the innovation and destroying any potential for take-up of the services, or impacting the trust of people, or causing losses for the fintech companies. So it's like a design of infrastructure, design of business flow, and design of regulations.
Okay, when it comes to, you talked about intelligent scoring, right?
Yes.
What does the intelligent scoring entail? I mean, is there any, let's say your e-commerce purchases, I mean, are those being taken into account?
Yes, you can. In order to build an intelligent scoring, you can access many sources of data. It's like wide variety of data because the technology now, it gives us the opportunity to analyze data and to predict behavior for the future. So we have utilities, you have the MNOs data, you have the mobile wallets themselves as a data, and other unconventional sources of data, like maybe social media, credit bureau itself, if I have any historical, e-commerce, payments, all these data, if you can. But the thing that I think we should always be aware of and prudent in designing it, how to, not only the variables collected, the weights of the variables, the weights, and should be the weight of the variable within the parameters of calculating the intelligent scoring. It should be more flexible concerning people themselves. Again, there's no one size fits all for even the customers. So not necessarily to have the same exact equation to calculate Maha's intelligence scoring as the same as Vivek, for example. So we should be more vigilant, more agile, and more centric according to the customers themselves. So not only designing their products, as well how to assess their risks.
Can people challenge their scores?
People can challenge everything, definitely. That's why we have within the communication strategy having even representatives from consumer protection, from clients or customers to themselves, so they will add into the business model. They will participate in designing the equation and the parameters, definitely. But people can always challenge everything.
Right.
This is at least our right as humans.
Right. And Norbert, the Alliance for Financial Inclusion is based in KL, in Kuala Lumpur. But you guys do work globally, and one piece of the work that you have done, a lot of is in Zambia. Can you talk a little bit about that experience and what the main issues have been? Is it more an issue of access, not so much an issue of privacy, for example?
Yeah, thank you very much for that question. I think the best is for me to combine the global approach with my Zambian experience, and then that will bring more context to it. I think the first start point is that one would want to identify maybe the three major buckets that from a regulator's point of view, you'll be looking at. The first question is the public policy objective. What is the public policy objective that you're trying to attain when you drive financial inclusion? And in the context of the AFI global picture, the start point is our Maya declaration. You find that, and again in the context of this conference, you find that under the Maya declaration, close to about 75% of our members on the global level have made commitments which are directly related to digital financial services. And I'll touch more on that in the context of fintechs. So in the context of fintechs, first is what do we want to do in that space as the Alliance? We want to focus on fintechs for financial inclusion. This is because fintechs as it is very broad, but for us to drive scale, we would like to focus on that particular element. And the second element, which is attendant to that, is the issue of we expect financial technologies to invent solutions that are transformative as opposed to additive. Because if they're not transformative, then we are not going to drive the scale that we expect in the coming horizon. So we expect fintechs to focus this. The second policy objective is obviously the need to drive those who are outside the financial system to get into the financial system and to be able to use the financial system and not just end up accessing the financial system. Then arising out of this, you start to see certain policy questions arising. And the first policy question is how do you leave the fintechs to innovate without standing in their way and also safeguarding the financial system? Now, as a regulator, when you ask yourself that question, it then leads you to another policy question. Now, as you try to allow innovation, you have to manage the risks. This is where the modern issues relating to sandboxes is coming in. As a regulator, you have to accept it. At this pace of technology, especially if you've walked around here today, you can see that innovation is always going to be ahead of regulation because there are people researching. So you've got to be open to that fact. And the key question that you need to ask yourself is how do you allow this innovation without threatening your financial system? And this is where we start to see regulatory sandboxes playing key or providing a safe environment under which you can test. Initially, without these sandboxes, we used to adopt what was called a test and learn approach.
Sorry,
test and learn?
Test and learn.
And learn approach. And if you ask me of the Zambian context, so this is where a provider comes to you and wants to offer a service. You're unfamiliar with the service. You don't say no. You say, okay, go ahead. I'll observe you and see how it comes, or what others will call a no objection. So this is absolutely key. Then the third element that I would like to end on is the aspect of risk management. And this is important because of two things. The issue of stability of the financial system is not only talking in terms, it's not only in the context of the disruption of payments, poor credit quality and things like that. Because you are driving the numbers and a lot of payment options are coming on technology, you could as well disrupt the economic system by failure of that specific technology, especially if the numbers on those platforms are actually high. So from that perspective, the regulators' antennas are always high to see what is happening in the market. And this is an appeal also to fintechs that when regulators request for more data, request for more understanding from your perspective on the solutions that you offer, it is not that they want to buy you, but they have this added duty of consumer protection. And it is from that perspective that you start to see this challenge.
But
and
sometimes,
finally,
but sometimes as a regulator, I'm sorry to interrupt, but sometimes as a regulator, you do get the sense that they might be listening too much to the banks. So that's kind of where you, as a regulator, you have to strike a balance, right? I mean, this is something that.
No, that's a very important question. I think this now just comes to the issue of the models that a regulator adopts. Again, as I said, in this innovative space, it would be ill-advised for a regulator to close their doors to emerging technologies and the emerging provisions and restrict themselves to the banks as the key players in the system. They are. And there will be for a considerable period of time. But I think models that need to be developed now are those that are responsive to developments that are coming from the sector. Let me end on the issue of capacity building and financial literacy. No doubt that capacity building is going to be key in this technology process, both for the regulator and the providers themselves. And also, more importantly, financial education and literacy is going to be absolutely key for the consumer to be able to understand products and services, and also be able to understand the redress mechanisms that will come with the technological thing. On our part, as AFI, we will continue scanning the environment to see what sort of challenges and risks these technologies give rise to, so that for our regulators and policymakers are better geared to sort of drive this forward.
Okay, thanks, Norbert. I have a question here that's come in from the audience, and it's about one question here is on promoting financial inclusion. Mentions the use of big data to score people. I'm supposed to press this button and it flashes up. Let's see if it works. Anyway, the panel mentions the use of big data to score people, to score people's credit. How does one's online behavior translate into credit scores? And is there a danger in using online behavior to determine credit scores? I guess any of you can answer that question. And let's have all of you answer that question. Let's start with Korn.
Well, I met up with a fintech entrepreneur recently who was talking about developing a credit scoring system based upon what you post on your Instagram, amongst other apps. So I said, how does that work? And well, he says, on your Instagram, we know what restaurants you go to, where you go on your holidays, what food you order, in the restaurant that you go to, who your friends are. And these are all salient and telling information on your financial standing. And I thought about it, and I guess that's true. Although I didn't ask the question as to whether, knowing that, I could game it, by basically trying to lie to the system, go to more expensive restaurants that I can afford, that kind of thing. And the answer was, you can to a degree, but in this day and age, with so much of your life on social network and digitalized, it's impossible to lie all the time, and the system will find you out. So I guess, yes, thinking about it is not a bad way of providing an added angle towards what your credit should be. So be careful what you post, I guess.
Yeah. But you sort of make a good point. I mean, the two adjectives that you use are salient and telling. But what salient may be, it may not be so salient, but it's still telling. So it's a sort of trade-off. Like, what are they looking at, and should they be looking at it? I guess is what's driving this question. But Vivek, do you want to take that?
So, what is a credit score effectively? It's a prediction. It's a predictive model. So the credit scores that I'm used to are, you punch in a set of numbers, it's past, it's historical. It's you're predicting the future based on someone's historical performance. But anyone who's lived through a financial crisis, and I've lived through 2.5 financial crises, knows very well that past does not always predict the future when you hit a crisis. People behave differently when they've got their back against the wall. So it's about prediction. So what these very innovative people have done is, I use past data, which is numbers, to predict the future. They are also using past behavior, and they've built pretty accurate algorithms which seem to work. And the beauty about this is that you're really talking about a pretty large sample size. You're not talking about 5 or 10 people. They're probably running into thousands, tens of thousands, if not millions of people at times. And their algorithms are pretty much working 24/7, and they're adapting based on the changes they're seeing. Now, I don't know exactly which particular behavior, but it's a combination of them. They've managed to link them. I asked this question that you raised, that so I can behave differently in order to get a higher credit. One is, what's the probability that a large chunk of your clients will do that? Second is, the algorithms, and I asked this question to somebody that we're working with, and his response was, we can see through that very often. I'm pretty sure these are not foolproof, nothing is foolproof, but I don't know what goes into these algorithms. I haven't tried to understand that, and I don't think I'll ever be able to comprehend, so I'm not going to try. But so far, and I say it with caution, it seems to be working reasonably well.
I agree with the previous comments. Just to add that first, credit scoring has been with us as long as lending has been. But I think the important thing is that online credit scoring is just an added dimension to the usual credit scoring. So it's probably given a particular weight to add to the overall score. But in some instances it's working, in other instances it's not working. Like for instance in Kenya, there is credit, mobile credit on the back of M-Pesa, which you can now access just based on your transactional history, and this is working. But also we know that credit scoring in the context of SMEs in many jurisdictions has also had its downside in terms of repayment afterwards. But it's a refinement process. And I think the more dimensions we start to add to the credit evaluation, the more qualitative the result will become at the end of the day. So it is something to look forward to. But I think the key takeaway for the consumer and why the consumer is challenging financial service providers is that even with this improvement in credit scoring, maybe it is not lowering their cost of borrowing. For instance, why should it be that if I prove very credit worthy, the next time I go to the bank, maybe it's giving me a loan at the same interest rate. So when effectively the cost of my borrowing is supposed to decline. So these are the questions that the providers need to answer, and they need to answer seriously if there will be credit or integrity to these new dimensions that are being added to credit scoring.
Actually, I expect that the more complex this algorithms become, the more it could be precise. However, people will get more accustomed to having more precise history. That's why I refuse to call it alternative credit scoring. It's more intelligent scoring, because it's not necessarily my credit background. All my personality, my commitment, my attitudes, the way I behave, it will really give inputs to my scoring. So it's not only about historical, it's predictive based on other elements. At the end of the day, people who borrow are human. So they react with people, they react on different occasions and situations. According to that, you should at least predict how committed they will be towards paying back or honoring their commitments and liabilities. It's more than credit scoring.
Okay, and sort of related to this is another question that's come in, and this apparently is the most popular question at today's panel. The question is, and I should tab this, Fintech can promote inclusion, but it can also lead to exclusion through more granular customer segmentation and differentiation. How can we encourage more inclusion and manage the risk of exclusion, which I guess is basically saying that some people don't deserve the kind of credit scores that they have. And let's just say for the record that I have Alipay, the Chinese app, and my credit score on Alipay is 598, which is just 2 points below the 600 that people generally regard as creditworthy. So I am technically, in the Chinese context, not creditworthy. But I guess this question sort of relates to that. Like who are you excluding and should you be excluding them? Anybody want to take a stab at this?
So I'm not sure I would agree. So let's look at the glass as half full. Today, X percentage of your population is excluded. So with technology and with TechFin, that percentage will go down. So the glass is half full. That's the way I would look at it. As simple as that. I mean, how can we encourage more inclusion and manage the risk of exclusion? I think, let's understand that these technology firms or TechFin firms are driven ultimately to go deeper into the market in a prudent manner so that they don't lose money. For them, they want to optimize profits as well. So if they can go deeper into a market, I see very little reason why they won't do that. Yeah. Unless there's a limitation of physical infrastructure or connectivity or things like that. Yeah. So yes, there is a risk of exclusion, but let's turn it around. Today, the risk of exclusion is this much. That may come down, which is better than here. That's the way I would view it.
Yeah, it's a very loaded question, this one. Yeah, it's possible. What is stated, it's possible that if the platforms, particularly end user platform, forget about the complexity that is driving this, but the end user, if it is complex, then when you are dealing with the lower levels, you may have a problem. So right now, they are used to these straightforward platforms in terms of access, in terms of drop-down menus. The more complex they get, the more challenges you face with the bottom of the pyramid. So again, this is a heads up to the innovators that the end user interface needs to be very friendly if we are going to avoid the risk of exclusion.
Let me disagree with you. I don't agree that fintech might cause more financial exclusion. It's not about the technology itself. It's about the design, the regulations, the policy interventions, the enablers. It's not fintech itself. So if we come up today with thousands of innovations that are outstanding and seamless, but the regulations are really very restrictive, so I cannot put the blame on fintech. So it's like an ecosystem with many variables. They should all work as an orchestra to ensure you have harmony among them. So it's not technology. At least we will ensure the minimum basic access for the very bottom of the pyramid. What you're talking about, it's moving forward from digital financial inclusion or transactional financial inclusion into deepening of financial services. So if I want now credit, digital credit, with a precise, comprehensive credit scoring, insurance or whatsoever. So definitely, when I start with the basic, the level of knowledge I have will become higher. So the more responsibility on the regulator and the service providers in the market for higher level of education and awareness and literacy. So it's like really an ecosystem that they all have to work together in synchronization to ensure. But I totally disagree that it might cause exclusion. We cause exclusion, regulators, players, and other players in the market. It's not fintech itself.
But fintech, just to correct the impression, I mean the end user. When you get your phone, you've seen that over time, where we were before to access anything was more complex than where we are now. You've got drop-down interfaces and just click a button, you are able to access. I'm saying if that end user interface, these innovations that are coming, keep getting that to be more complex, then there is a risk that, because as we were at 3 billion, we are now at 2.5 billion, we will then go to 2 billion. Now, as you go lower, the core that you are dealing with is one of more challenges, because the ones that had less challenges tend to access the financial system quicker. When you go lower, you've got challenges of literacy, you've got challenges of digital literacy as you go lower to the pyramid. And therefore, it means that you have to develop solutions that are responding to those challenges at the lower. That's the point which is being made.
One last point, as I represent the regulator here. This is where another advantage of regulating fintech. Regulating fintech shouldn't be about putting regulations, like specific sets of regulations. It's part of regulating. Positive regulation is the regulator will understand what's going on. So the culture where the regulator should as well cooperate with the fintech, guide them, give them not advisory services as much as it is guidance, trying to end up or to come up with something very seamless, very friendly user, and to do together some other tasks and duties about literacy and helping people to understand. Definitely my father, he found at that time the feature, mobile device, something wow. I don't know if he's still alive, what he would say about Skype, about Viber, about having money within a wallet. So definitely, but it's gradual, and this is where we come our turn. AFI, for example, they are doing a great job in this regard, regulators and other enablers in the market. It's at the end of the day, one end product.
We're sort of running out of time, but Korn, you've been a regulator too. So, well, sort of.
A policymaker is different from a regulator, yes.
Right.
The regulators keep us in check as well. But I think the main point here, I like what Norbert was saying, is that with improved technology, improved credit scoring, as Vivek says, that's going to make the glass become more full. That's a good thing. But bottom line is whether that translates to lower cost borrowing, better access to funding. And that's all to do with regulation, allowing it to take place. It's all to do with competition, and creating space for new players. In my country, the biggest question at the moment is, what attitude should we have as policymaker, as a consumer, as an incumbent financial institution towards the almost certain entry of the non-bank megamoth, the Alibaba of this world, the JD.com, the WeChat of this world, who are already in Thailand servicing mainland Chinese tourists. The next step is going to be a move towards providing financial services to Thai citizens. That is going to be a huge change. On the one hand, obviously positive for users of financial services, more competition, almost certainly a lot cheaper loans, more readily accessible loans, and so on and so forth, which is all good. But how that impacts on the overall financial sector, on the security, financial security for the country longer term, are open questions, which challenges both the policymaker and certainly the regulator. So it may address the financial inclusion equation, but it begs a lot of new questions as well that still needs to be answered.
Absolutely. And with fintech developing the way it is, you guys have your work cut out for you. And on that note, I just want to say thanks, everyone. This has been a really enriching discussion for me. Thanks very much.